This is Funder. When you subscribe, you learn how to turn knowledge into money. New Zealand has been walking through a fog. People keep asking the same question in different words. Are we at the bottom? Is this the turning point? Has the pain finally hit its limit? That silence you hear is the uncertainty. It sits in every household, every business, every mortgage statement. We have been told to be patient. We have been told it will pass. But patience is not a strategy and hope is not a plan. So today we do what the country has been waiting for. We tell the truth with Jarrod Kerr, Chief Economist at Kiwibank. Jarrod, we've been asking, are we there yet? And is this the low for rates and the economy? What's your current call? Have we bottomed out or are we still bumping along the floor?
I think we've bottomed out. I think this is the low in the cash rate. We seem to have gained a bit of traction in the last few months. So for me, that's a pretty good indication that they've taken monetary policy into stimulatory settings and it's having an impact. We hope it lasts. I've been, calling green shoots for a while now, and they keep, emerging and then sort of dying away. One of our business customers the other day said, "Please stop saying green shoots. Like, come up with something else. Like, we're sick of it." It's like, yeah, fair point. Maybe let's just call it the recovery, and hopefully it is the recovery.
GDP was about 0.2%, pretty flat. What's the story behind such a weak headline while some indicators look better?
So we had a really bad recession last year, and we thought we were going to bounce out of it now, basically. We thought the first half of 2025 is going to be a bit awkward, and then we'll start seeing the bounce. What we actually got was quite a contraction in the first half of this year, much worse than we had anticipated. We actually went backwards, which is a real problem. But now in the second half of the year, things are just starting to pick up. The higher frequency data looks a little better. Labor market data looks like it's stabilizing. And that to us suggests that we'll get some growth next year. So yeah, we had a bad 24. We had a really frustrating 25, but we're going to have a better 26.
That frustrating 25 was somewhat engineered by the RBNZ and government policy not being swift enough.
Yeah, I think we can call them out. I think we can call them out for sure. Like, the Reserve Bank, in my opinion, tightened too high. They put interest rates too high. It caused too bad a recession, and they left them restrictive for too long. We've only now seen interest rates go into stimulatory territory with that 50 basis point cut in October, another 25 in November. We're in stimulatory territory only very recently, right? So it seems to be taking hold, but I think we can call out the Reserve Bank for, first of all, driving us into recession, and then second of all, not getting us out of it fast enough.
The OCR is 2.25%. In your view, is that the floor for this cycle? What would have to happen for another cut?
Yeah, so we said 2.25 will be the bottom, but we left open the optionality, if you like, of a rate cut in February. We're really wanting to see how the economy performs over summer. So we're definitely not ruling out any more rate cuts. Rate hikes are something for well into the distance. But yeah, I mean, we're at a point now where the settings feel like they're about right, but we really need to see that translate into activity, and we're going to hopefully see that over summer. If not, then yeah, they need to cut more.
Markets have swung hard on the differences versus the RBNZ track. Why are wholesale markets so jumpy at the moment?
So there's a really big difference between signaling more rate cuts and signaling nothing. Markets will not trade sideways. They will either be factoring in rate cuts or factoring in rate hikes. And the Reserve Bank basically removed much of the probability of rate cuts. So the market's gone, well, if they're not cutting and this is the bottom, then the next move's a rate hike. And that's starting to be built into wholesale rates in the second half of next year, second half of 26. So, yeah, markets swung massively from forecasting cuts to pricing in hikes.
And the biases would be for pauses or
I'd love to see pauses. I would love to say this is it, like this is the low, and that is what we're saying, but we're just not 100% confident yet. We are saying this is the low, so hopefully we come in next year. The economy has gained traction, and it is the low. At which point we'll see a whole bunch of pauses at 2.25. They'll keep it there for a while to make sure the economy is recovering. And then, if all goes well, then we may be talking rate hikes in the back end of 2026, maybe early 27. But that would be a good thing. Like we'd be lifting rates out of stimulatory territory because the economy's recovered.
looking back now, what's the lesson for the next cycle and how should the bank avoid creating another engineered recession?
Well, I think we can learn a lot from the Australians. The RBA was much more relaxed in the post-COVID period. They allowed the economy to run hot for a little longer. They didn't hike as much. They didn't cause a recession. Australia has not recorded a recession. And, they've eased, but they haven't had to ease as much as the RBNZ. So, doing less is more, in some cycles. In the last cycle that we've been through, the RBNZ should have done a lot less both ways. But, here we are. They did more on the rate hikes and they're having to do more on the rate cuts simply because they drove such a bad recession.
I don't know the figures, but I'm guessing the Australian government didn't pump as much cash relative to how much cash New Zealand pumped through during those COVID years. And the RBNZ was reacting in a bigger way because there was more of a catalyst.
Yeah, I mean the Aussies definitely did a lot of things, but relative to GDP, relative to the size of the economy, we did more. And we had house prices absolutely explode. Like our house prices were up 45-46% in just 18 months. So then you had both the Reserve Bank and the government trying to rein that in. So yeah, that was a problem created out of COVID. But even then, I think we could have managed it a bit better.
Yeah, benefit of hindsight, but also
Yeah, absolutely.
lessons for the future. Most people treat their KiwiSaver the way they treat an old photo album. They know it exists, they know it matters, they never bother to open it. And that small act of neglect can cost them more than they realize. If you want clear, simple guidance on choosing the right provider and the right type of fund, you can talk to Wealth HQ without paying a cent. Maybe you like the thrill of crypto. Maybe you want nothing to do with investments that profit from conflict. Maybe you just want a sense of control over where your money goes. Wealth HQ strips the uncertainty out of the process. If you want to understand your options, then click the link below and it will take you there. Where do you see inflation risk sitting today? Genuinely beaten or just resting?
I'd say genuinely beaten. And it's quite a strange thing to say when, inflation's lifted from 2.2 to 3, and there's a whole lot of stuff in there that is really ugly, like food prices are up so much. That's somewhat seasonal. That'll come off in the fourth quarter of 25 and the first quarter of 26. So that'll ease. But then you've had a lot of what they call administered prices, like council rates rising at double-digit rates. So there's a lot of inflation there. But we look through that temporary stuff. And when you cut out some of the more volatile stuff, inflation's heading in the right direction. Like it's heading back to 2. And the fact that we've had a recession and there's a rise in unemployment and there's falling wage pressures, it points to inflation actually falling below 2% in the second half of next year. So it's like, well, we're experiencing all this inflation how are you forecasting, inflation to be below 2? It's like, well, we look through the temporary stuff. We look at the bigger forces that are at play, and those bigger forces have inflation easing quite rapidly next year. And the Reserve Bank obviously agrees, otherwise they wouldn't be cutting either.
What's the one domestic driver that you think will decide inflation's path through 2026?
I don't think there's one. I think the main thing is that we've been through a recession, and that frees up a lot of resources. So the labour market, for example, is nowhere near as tight as it was a couple of years ago. Businesses are not paying that 5% plus, wage growth that we saw. So that big part of it is heading south. We do see the tariffs globally as being deflationary, not inflationary. So that international force will be weighing on prices here, and we've seen it in electronic goods and a bunch of stuff that we import. So there's a lot of things happening, but they're pointing to downward moves in prices, not up.
How are you reading the labor market now? Is it a soft landing or still deteriorating? And what's your unemployment view for 2026?
It's not a soft landing. It was a very hard landing. It's easy to look at the labor market and go, well, the unemployment rate went from 3.2 to 5.3. That's bad, but it's not as bad as what we saw during the GFC. It's not as bad as what we've seen in other recessions. It's like, yeah, no. Go one step further and have a look at the underemployment rate. So people who have a job but don't have the hours that they need, like they want to work more, you add them to the mix, and the underutilization rate is 13%. Now that's high. Who have been hit the most? Well, it's your younger workforce. So I kind of like this first in, first out, hiring. You get in these younger workers, but when things turn south, you try and keep your more experienced workers, and the younger ones are the first ones that you let go. So not only is the unemployment rate much higher if you're under 25 years old, but the hours that you're getting are a lot less as well. So it's a soft labour market, as you would expect following quite a bad recession.
Do wage trends now look inflation consistent, or are we shifting into a weaker demand story?
Yeah, it does. So we saw the inflation rate really explode post-COVID, and it got to about 7.3%. During that period, obviously, it was quite a tight labour market as well, and employees were demanding much higher wage increases, and we were seeing, 5, 10, 15, 20% pay rises. It was quite extraordinary. So the wage growth got up to about 4.7. Now we're below 3. So inflation has eased back, well, mostly, and wage growth has eased back as well. So that puts less pressure on businesses, and that also puts less pressure on businesses having to pass that on to higher prices.
Retail volumes lifted strongly in Q3. Is that a real consumption turn or a discount driven burst?
I think it's a bit of both. We're looking at it. Our transactional data at Kiwibank shows that there was a lift. It shows that there was a lift in not just essentials, which have gone up in price. So there's an inflation element there, but it also the more interesting stuff, the more fun spending. We've seen a bit more of discretionary spending. Looking at the price impact, we saw a massive increase in spending on electronics, and more of the fun stuff. And that was on the back of some pretty heavy discounting. So the deflators, I think, have been down for 3 quarters in a row on a number of those sorts of goods. So, yeah, a lot of heavy discounting. I mean, it was funny. I joked with my wife, Black Friday was like 5 Fridays in a row. And the amount of the
Yeah,
the
Black
amount of
November.
counting, yeah.
You've noted a big chunk of households refix on lower rates soon. How powerful is that cash flow boost for spending in 2026?
Yeah, it's really important. Like that's the whole monetary policy transmission, like you're cutting the cash rate, but that doesn't matter. Like no one deals at the cash rate. We're dealing at mortgage rates and business lending rates, and they've all come down. And it's how fast do people roll off to get onto these lower rates. And they've been rolling off rapid fire. Like people have been fixing for 6 months in anticipation of further rate cuts. It's been a great outcome doing that. It really has worked, and those people are rolling off as we speak. I think about 80% of the entire mortgage book, is rolling off in the next 3 to 6 months. A lot have already rolled off. It's a massive part of the story, and we're hearing it from our customers. You know, they went from twos into the sevens, and then they were in the fives, and you could just hear that them breathing a sigh of relief. Whereas now we're in the fours. People are like, oh, I might spend a little more. Like going from 7 to 5.5. I think people repaid, more, but now they're not asking for that lower repayment number that they're sticking. Sorry, they were sticking, but now they're actually taking the lower repayment and spending elsewhere.
Business confidence is lifting fast. What are firms telling you on the ground that explains that shift?
So firms get it, right? They get it. They've had a whole lot of issues that they've had to deal with in recent years. There was COVID. A lot of them had to take on debt just to get through COVID. In the last few years, they've repaid that debt. They're sort of back on their feet now, and they're looking at an economy which does look like it's recovering. And it's been a tough ride. They're still really frustrated. I'd say that would be the common word. It's been a frustration. 2025, we just didn't get the recovery that we wanted. But now that interest rates are at a level that actually entice investors and business owners, I think they're becoming naturally more upbeat going into next year. Confidence is one thing, activity is another. We've seen confidence lift before. We saw it when National was elected. We saw it when the Reserve Bank started cutting, and each time it died away. We're hoping this time that business confidence is lifting because interest rates have been cut far enough. We hope it stays up there, because what we really need to see to say, hey, look, we're in a proper recovery, is businesses investing more, and then ultimately businesses hiring more. We're not seeing that yet. We've seen the lift in confidence. That's great. Get out there and buy that machine that you need, because you're manufacturing whatever into Australia. Just get out there and get amongst it.
Infrastructure is a huge conversation right now. From a macro view, what kind of infrastructure spend actually boosts productivity versus just boosts short-term activity?
So, infrastructure investment, if you're investing in proper infrastructure, that is your long-term, investment, your long-term impact on your economy. Now, that can be anything. That can be a road that takes you up north, and it cuts the time between going from Auckland to Whangarei, right? That should have been built. That is a classic example of a lift in productivity when it takes you, an hour or an hour and a half to get somewhere, and it used to take you 2 hours plus. That's a great example. Another example is where you might have built a road or rail, but you've also put in a whole lot of utilities like electricity and the likes, and it unlocks some land that would have otherwise just sat there for housing. and next minute you're building more homes, the housing market becomes affordable, and you're in a better situation. Can also mean, putting money into schools, putting money into hospitals. We've got an aging population. Investment in education is right up there when you start thinking about productivity in an economy. There's just so much we can do on the infrastructure front. Some research suggests that our infrastructure deficit's between 100 and 200 billion. You start addressing that, and the return that you get on that investment is actually quite high. You get a harder, faster, more powerful economy. And oh, by the way, that harder, faster economy is a bigger tax base for the government. So, yes, we need a hell of a lot more infrastructure just to, backfill the lack of investment we've seen over the last 30 years. But if we really want to make sure our economy is future proof, we've got to spend the money now.
Jarrod Kerr, Chief Economist at Kiwibank. Appreciate your insights today, and we'll see you again soon.
Pleasure. Thanks.
Most people treat their KiwiSaver the way they treat an old photo album. They know it exists, they know it matters, they never bother to open it. And that small act of neglect can cost them more than they realize. If you want clear, simple guidance on choosing the right provider and the right type of fund, you can talk to Wealth HQ without paying a cent. Maybe you like the thrill of crypto. Maybe you want nothing to do with investments that profit from conflict. Maybe you just want a sense of control over where your money goes. Wealth HQ strips the uncertainty out of the process. If you want to understand your options, then click the link below and it will take you there.